Hello and welcome to Smart Money, your favorite weekend show. Today we're going to talk about the big sell-off in US technology stocks and how this has impacted mutual funds in India, which have global exposure. Now, the Nasdaq index has lost almost 12% this year, underperforming Indian indices like Nifty, which is down just 1.5%. In fact, within the US markets as well, tech stocks have corrected further. The Russell US Tech Index is down almost 13% this year. Many mutual funds in India have exposure to US tech stocks. So we will be speaking with Niranjan Awasthi of Edelweiss, who joins us today. He manages the Edelweiss US Tech Fund. He, of course, is the head of Edelweiss as well in terms of marketing the products, etc. But he's also going to tell us about what investors should be doing after the recent correction that we've seen. So before that, Niranjan, just putting up some stats. I think our viewers just had a quick sneak peek. But this is how much the stocks and indices have fallen. First, if we can get the previous plate, just to show our viewers how much the markets have fallen compared to the Indian markets, right? So the US markets this year, look at that, S&P 500 down 7%, Nasdaq down 12%, the Russell Equal Weight Tech Index down 13%. Although in the last 1 year, the markets are still up. So year to date, the markets are under pressure. Compared to the Nifty 50, there is an underperformance. Now let's go to the stocks, right? The US tech stocks. This is the kind of correction that we've seen. Meta has seen the deepest fall. Tesla is down about 30% this year. Amazon is down almost 10% this year. And across the board, Microsoft, Alphabet are all down 8 to about 13% or so. And finally, if you are an investor in US tech funds, then this is the kind of correction that we've seen in the last 3 months for these funds. So the Axis Global Innovation Fund is down 12.5% from its peak. The Edelweiss US Tech Fund is down almost 20%, and the Kotak Global Innovation Fund is down about 18%. A couple of other funds will also come up for you. The Motilal Oswal Nasdaq 100 Fund is down about 10%. So Niranjan, that's the first question, right? Many investors have invested in US funds recently. Can you tell us, since the US markets have performed in quite a disappointing way, what does one really do now?
Right. So thanks, Sonia, for having me on the show, and hello, everyone. Over the last, YTD basis, definitely U.S. markets have seen a steep correction. I wouldn't say very steep because in past equities, particularly U.S. equities, have seen much more sharp correction. But YTD, definitely U.S. markets have seen correction. Within that, if you see, U.S. tech stock specifically has corrected a lot. And they have underperformed largely the Indian equity markets, and a lot of investors who have invested in these stocks, or maybe via through mutual funds or directly over the last 2-3 years in India, would definitely be worried. So if you ask me what is the reason, of course everyone knows it. There's nothing new to it. Is US Fed is starting to taper its bond buying program, and it's set to increase interest rate in US after a long period of time, which definitely has some impact, and we'll get into details why they get impacted and all. But that broadly is the reason why we are seeing US equity market and specifically tech stock going down.
So, I mean, since we're talking about the reasons, right, we do know that in a high interest rate scenario, generally equities tends to underperform. But particularly
Right.
when we talk about the fall in the US markets, it's been quite severe, Niranjan. So, should investors be concerned at this point in time? And if you can look at the past performance, every time there's been, a rate increase, what has the commensurate move been on equity markets globally and then on tech funds as well?
Right. So let's understand when interest rate rise, why do basically particular stock, correct? When interest rate rise, usually the valuation of some stocks, which tends to be usually on a higher side, they correct a lot because the rate at which you discount the forward cash flows of these stocks, the discount rate gets increases. And that is a technical reason. The other reason is people also believe that when interest rates rise, the economy will take a shot, and the growth will get impacted. However, one should note that whenever interest rates are increased, whenever the Fed decides to increase rates, it usually increases when the economy is on a strong footing. The earnings growth are very, very healthy, And historically, we have seen, at least in the last 6 rate hike cycles, which were spanning somewhere around 18 months on an average, S&P 500 has returned almost 13% on an average during all these 6 rate hike cycles. So typically, the correlation with interest rates rising and equity is positive. Whenever interest rates have risen to a certain level, equities have actually responded positively over a medium term time. Definitely in the very near term, when Fed is trying to tell the market that the bond tapering program would start, interest rates will rise. That particular time, usually the stocks are very, very volatile, but over a period of time, they adjust to the reality, they adjust to higher interest rates and tend to perform basis their underlying earnings, because we all know ultimately the stocks return mirror their earnings growth. So historically, this has happened. And I think so investors should not be worried.
Okay, investors shouldn't be worried. Since we're
Similarly,
talking
if you
about the
see,
numbers,
yeah.
I mean, I think I briefly heard you say that in the last, when there were the 6 interest rate hikes that took place, the S&P 500 has actually given positive returns post that.
Absolutely.
So can you do a quick analysis for us on what the impact on the US markets has been precisely in the last few rate hiking cycles, and within that, what has the impact been on big technology stocks?
Right. So particularly if you see, let's take example of 2013 to 2017, a similar period where 2013 US Fed announced that they will start the bond tapering program. They ultimately started increasing rates 1.5, 2 years later, which went on until 2017. During this period, if you see the S&P 500 returns in INR terms, 2013, it was up almost 34, 35%. 2014, 15, 16, on an average, it was up around 13, 14%. And even 2017, when ultimately interest rates were at its peak, 2017, 18, S&P 500 in INR terms returned almost 22%. So this entire period of 2013 to 17 was one of the best periods for US equity markets in terms of performance. When we talk particularly about the tech stocks, now we at Edelweiss run a US tech portfolio. The underlying fund is JP Morgan US tech fund, which can be taken as a proxy for what's happening in the US market and how the tech stock react. If you look at the data, the first rate hike cycle between 2013, when the yields increased by almost 1.5%, this particular fund returned almost 22% during that period. A similar cycle of yields going up during 2015, and then subsequently in 2017 and then 18, 19, all these cycles where yields have increased or interest rates were rising, on an average, this fund has returned a healthy double-digit return. The reason for this is US tech stocks specifically, they have very low correlation with US interest rates and US yields. And one of the reasons could be the tech stock. If you see over the last decade or so, this sector, in fact, is the sector with one of the highest earnings growth. And ultimately, as I mentioned, the stock returns will always depend on the underlying earnings growth in the companies. And that is what at display in all the scenario. And we believe over the next months or quarters or even 1 or 2 years, as interest rates gradually rise, while tech stocks are currently at lows and have seen some correction, ultimately good quality tech stocks which have a very strong earning growth would definitely help investors make some returns in their portfolios.
Okay, so that is a pretty convincing argument. You're saying that the US tech stocks don't have a very positive correlation with the interest rate rise and the rise in yields. They don't have too much of an impact as well. At the end of the day, it all boils down to earnings, and the earnings for these tech companies are very strong. That I take your point, because we're getting positive commentary from a lot of the tech companies globally as well. Let's do one thing. Let's slip into a short break, but don't go anywhere. We'll come back, take up some of your queries as well, and continue talking about the big fall that we've seen in global tech stocks and the impact that that has on your portfolio, especially the US-based mutual funds. Stay tuned. Welcome back to Smart Money on CNBC TV 18. We are talking about the big fall that we've seen in global tech funds and global tech stocks, and what one should be doing now if you have exposure in those funds. We have Niranjan Awasthi, the head of product marketing and digital business at Edelweiss Mutual Fund. Edelweiss runs a tech fund as well. So we're asking him what they're recommending investors to do. Niranjan, before the break, you were telling us how in a high interest rate scenario, actually the S&P 500 has always delivered positive returns, about 15 to 20% on an average in the last many years. And tech stocks have done well because that's a high growth sector. So what should investors in US-based funds do? The same funds that have fallen about 10-15% in the last 3 months. What's the advice now?
So as an investor, one needs to understand why we invest in overseas funds or overseas. We invest for diversification. If you see the correlation of US market with Indian market, it's barely around 0.06% over the last 30, 40 years, which means there are times when US market won't do well and Indian markets would do well. And there are times when it would be reversed. So case in point, a year like 2011, in INR terms, US market returned almost 22%, whereas Nifty was down almost 22%. So if you have a blended portfolio, you have a diversified portfolio, your portfolio would be benefited. Similarly, in 2015, when US markets were up, or 2017, when US markets were down, Indian markets were up almost 30%. A similar period where one market is down, another market is up, a diversification diversification benefit would kick in your portfolio. So investor needs to understand that there won't be periods when both Indian as well as some other markets like US would do well. US market, as you pointed out, Sonia, have done really well, and particularly the tech stocks over the last 2-3 years. If you see the returns over the last 3 and 5 years, they have been on a very high double-digit return in the range of 20-25%. A period like this, when interest rates are rising, some of these tech stocks are pricey, you would definitely see volatility. The another point one should remember is in equities, you will always see the best periods of return coming very closer to the bad period when the returns are bad. So ultimately, you can't time the equity markets. You can't time when you get in and when you get out. The best strategy is to stay invested. And in fact, the better strategy would be to invest when markets are down, because if you're investing during the bad days, the probability of catching hold of the best days of equity markets would be much, much higher. So the advice to a lot of investors would be, don't worry at all. You have invested for diversification benefit. US markets will be volatile in the initial cycle of rate hike, but if the underlying earnings growth is strong, if the underlying economy is strong, definitely they would add value to your portfolio.
Okay. So, you were telling us earlier that this Edelweiss fund, which has an exposure to global tech stocks, it's benchmarked to the JP Morgan US Tech Fund, right? So how did that's the underlying fund, right? So how did the JP Morgan US Tech Fund cope with the rising yields in the past? I mean, just to understand the trajectory of what happened the last time around when yields rose?
Right. So, one thing we need to understand, as I mentioned, tech stocks have been one of the have been at the forefront when it comes to earnings growth. The projected earnings growth for US market, which is S&P 500 over the next 1 year, is around 8.5%, whereas the projected earnings growth for our fund, which is the Edelweiss US Tech Fund of Fund, and the underlying fund is JP Morgan US Tech Fund, is around 20%. This itself shows that how the portfolio could grow if it is just to mirror the underlying earnings growth. So whether interest rates are rising or falling, over a medium term, if earnings are going to grow, definitely there is returns which can be made. Similarly, in the past, as I mentioned, the correlation of interest rates and these tech stocks have been very, very low. In fact, it's been almost zero over the last 1 or 2 decades. In past, whenever there have been an interest rate hike, this underlying portfolio, this underlying fund has generated, in fact, positive returns. And a lot of people would be surprised looking at this. 2013 period, the returns were almost 20-22% during that period. In fact, that last entire cycle of 2013 till 2018, this strategy have generated one of the best returns. And that period was when interest rates in US were rising and bond yields rose from the lows of 0.6 in 2013 to almost 3% during this period. So this itself is quite convincing for investors to stay invested.
Okay. Just one final question on the reason for the correction. What do you see as the main reasons for why these global tech stocks are under so much pressure, particularly that pocket? Because we've seen, names like Amazon, Tesla are all down. That whole range is down anywhere between 10 to 25%. Is it only because of the overvaluation and the surge that we saw last year that's getting corrected? Or are there any other reasons why there's this big fall that we've seen in tech stocks this year?
So tech stocks, I would divide in two or three, cohorts. If you see the larger tech stocks, which have a very strong underlying earnings, have not corrected much. So what you're saying is true for some of the stock because of some stock specific reason, but on an average, the large cap tech stocks have corrected in the range of maybe 10 to 12% or 10 to 15%, which is in line with S&P 500 or broader market correction. However, if you see the larger corrections in tech stocks have happened in the small cap names or names where there's no underlying earnings. And when there was a low interest rate scenario where money was cheap, a lot of money was chasing these kind of stocks where there was a hope that over the next 1 or 2 years there would be earnings growth. However, when interest rate rise, these kind of hopes get scratched, and these particular stocks have corrected a lot. In some cases, they've corrected almost 30, 40, or 50%. So these are the two segments where we have seen correction, which is very broad in line with the market in the large cap tech stocks, which are very stable. The earnings growth are still visible and very, very robust. However, the other side is very, very small, startups kind of companies which have got listed in US, and they don't have earnings today, but a lot of people were buying them with the hope that they would project some earnings over the next 2-3 years. A diversified portfolio is very, very recommended at this kind of time, and hence an active strategy where a fund manager, separates these stocks from the stocks which are actually going to grow healthy is very, very important. So remaining invested in quality stocks where earnings growth is visible would be very, very important for investors at this point in time, I would say.
All right. Well, thank you, Niranjan, for calming some frayed nerves there, because it is a challenging time, especially for people who have exposure to these tech funds, which have been under a lot of pressure. But as you said, the earnings growth is pretty strong for these companies. The sector is in a big boom as well. And history has taught us that rising interest rates have always resulted in positive movements in global equity markets. Well, with that, it's curtains down on another edition of Smart Money. Thanks so much for watching.